They tried to kill it. They failed. Listen to me very carefully. If you sold silver at $103 this morning, you just handed your wealth directly to Samsung and the Pentagon. You became the exit liquidity for the largest industrial giants on the planet. While you were panicking, refreshing your portfolio, watching that red candle pierce through $105, then $104, then $103, industrial buyers were slamming the buy button with orders worth hundreds of millions of dollars. This wasn't a correction. This wasn't a market crash. This was a calculated execution, a stop-loss hunt, a coordinated takedown designed to shake you out of your position so that the big players could accumulate at a discount. And here's the most beautiful part, the part that proves they're desperate, the part that tells you we're winning. It didn't work. Silver hit $117. They crashed it to 103s. That's a $14 drop in minutes. And where is it now? $112.50. A perfect V-shaped recovery. That candle pattern, that violent rejection wick, that instantaneous snapback, that's not what happens when something is fundamentally broken. That's what happens when whales are buying the dip. Let me paint this picture for you. Somewhere in Seoul, a Samsung executive is looking at their battery division's silver requirements. 1 kilogram per vehicle, not 20 grams like the old lithium-ion batteries. 1 full kilogram. Their entire electric vehicle transition, their entire future, depends on securing that metal. And the spot price just dropped $14 in 15 minutes during Asian trading hours. You think they're sitting there worried about a correction? No. They're making phone calls. They're wiring money. They're buying physical metal while the paper price is in free fall. And they're not alone. The Pentagon, the United States Department of Defense, has 0 strategic silver reserves. 0. They need silver for missile guidance systems, for radar, for munitions, for the entire infrastructure of modern warfare. They announced a $2.5 billion emergency stockpiling program in 2025 because they're competing with Samsung and China for the same metal. You think they're looking at $103 silver and getting scared? No. They're thanking whoever crashed it for giving them a discount. You sold to them. If you panic sold this morning, you literally transferred your position to the most powerful industrial entities on Earth at a 15% discount. If you are glad that silver recovered and the banks failed, hit the like button right now. Let's force the algorithm to show this truth to everyone who sold at $103. Crush the like button to expose the manipulation. But before I break down exactly how they pulled this off, before I show you the forensic evidence, the technical indicators, the smoking gun that proves this was manipulation, I need to know something. Stop what you're doing right now. I need to know who's still awake, who's still in this fight, who understands what we're witnessing. Go to the comments right now. Tell me what time it is, where you are, and where you're watching from. New York, London, Mumbai, Tokyo, São Paulo. I don't care if it's 3 a.m. where you are. I don't care if you should be sleeping. Drop your location in the comments. Let YouTube's algorithm know that this movement is global. Let them see that the resistance against financial manipulation spans every continent, every time zone, every demographic. Comment right now. Do it. Because when they try to suppress this video, when they try to shadow ban this channel, when they try to silence this message, I need the algorithm to see that people from every corner of the planet are paying attention. Your comment is your vote. Your comment is your voice. Use it. I'll wait. Good. Now let's talk about what actually happened this morning. Let's pull back the curtain. Let's expose the exact mechanics of how bullion banks crash markets and why they chose today, this moment, these specific hours, to execute their attack. The crash happened during the Asian-London overlap, specifically between 2 a.m. and 5 a.m. Eastern Time. This is not a coincidence. This is not random. This is the lowest liquidity trading window in the entire 24-hour cycle. American traders are asleep. European retail traders haven't woken up yet. The only participants in the market during these hours are algorithms, institutions, and the banks themselves. Why does this matter? Because liquidity is everything. During the New York-London overlap, when both major markets are open simultaneously, there are millions of participants, buyers and sellers everywhere, tight spreads, deep order books. To move the market 10% during peak hours would require billions of dollars in coordinated selling. But at 3 a.m. Eastern, when U.S. traders are asleep and only a handful of Asian institutional desks are active, you can move the market 10% with 1/5 of that capital, maybe less. The bid-ask spreads widen by 50 to 200%. There are fewer counterparties, fewer limit orders waiting to absorb selling pressure. The market becomes fragile, vulnerable, and that's exactly when they strike. This is the same playbook they used on May 1st, 2011. Silver crashed 12% in 12 minutes during Australian-Asian trading hours when U.S. markets were closed. Same strategy, same execution, same intent. It happened again in July 2017. Silver futures plunged 11% from $16.15 to $14.35 when, and I'm quoting directly from the analysis here, US and European markets were closed, so thin trading from Asia exacerbating trading algorithms was largely blamed. Thin trading, algorithms, Asian hours, does this sound familiar? And just last month, December 28th through 29th, 2025, silver crashed from $83.90 to $73 during the Christmas to New Year period, the single lowest liquidity week of the entire year. Everyone's on vacation. Trading desks are skeleton crews, retail traders are with their families, and the CME Group, the exchange that operates the silver futures market, decided that was the perfect time to increase margin requirements from $20,000 to $25,000 per contract, a 25% increase. What does a margin hike do? It forces leveraged traders to immediately deposit more cash or liquidate their positions. If you were trading silver futures with borrowed money and you don't have an extra $5,000 per contract sitting in your account, you have two choices: wire money immediately or get liquidated automatically by the exchange. During Christmas week, when banks are closed, when liquidity is non-existent, thousands of retail traders using leverage were forced to sell simultaneously, not because they wanted to, not because silver's fundamentals changed, but because the exchange, a for-profit corporation whose clearing members are JP Morgan, Goldman Sachs, and the very same bullion banks that are short silver, changed the rules in the middle of the game. And they did it again. December 26th, margin increased to $25,000. December 30th, another hike to $2,500. That's a 30% increase on top of the first one. January 7th, margins held at $32,500. That's a 47% total increase in 2 weeks. Every single hike happened at or near local price peaks. Every single hike triggered immediate liquidations. Every single hike benefited the banks who were on the other side of those trades, buying what retail was forced to sell. This isn't speculation. This is documented. The CME's own rulebook states they can raise margins at any time without notice. They don't need your permission. They don't need a reason. They don't need to wait for a crisis. They can simply decide on a Sunday night, on Christmas Eve, on New Year's Day, that the deposit required to hold a futures contract just doubled. And if you can't pay, you're out. Liquidated. Gone. The CME is not a government agency. It is not a neutral arbiter. It is a for-profit corporation. Ticker symbol CME, traded on NASDAQ. Its clearing members, the institutions financially responsible if a major default occurs, are the same banks that are currently short silver and have paid over $1.3 billion in fines for manipulating precious metals markets. Let me say that again. The banks that manipulate silver are the same banks that control the exchange's risk committee, the same banks that decide when margin requirements go up, the same banks that profit when retail traders get liquidated. This is not a free market. This is a controlled demolition with a profit motive. Now let's talk about volume, because this is where it gets really interesting. This is where the V-shape tells the whole story. At the bottom, right at 103, there was a massive volume spike. We're talking about 50 plus million ounces traded in a matter of minutes. That's 3 to 5 times normal trading volume for that time window. This is not retail panic selling. Retail doesn't have 50 million ounces. Retail doesn't have the capital to move that much metal. What you're seeing is institutional accumulation, whales, giants, pre-positioned limit orders that were sitting there waiting for the price to touch $103 so they could scoop up everything the leveraged traders were forced to dump. Look at the candlestick. That long lower wick, that's called a rejection wick. It's one of the most reliable accumulation patterns in technical analysis. It means sellers exhausted their inventory at the low, and buyers stepped in with overwhelming force. The price didn't grind slowly back up over hours or days. It snapped back immediately, violently, from $103 to $112.50 in a fraction of the time it took to fall. That's not organic price discovery, that's engineered liquidity absorption. Here's another data point. The cumulative volume delta, the CVD indicator, measures buying pressure versus selling pressure. During the crash, while price was falling, the CVD turned positive. Price going down, but buying volume going up. This is called divergence, and it's a leading indicator of trend reversals. When this indicator flips positive during a decline, it signals that informed investors, institutions, sovereign wealth funds, industrial buyers are accumulating against the prevailing sentiment. They're buying when everyone else is panicking. They're positioning for the reversal before it happens, and they were right. The price reversed, the V-shape formed, and everyone who sold at $103 is now watching from the sidelines as silver consolidates above 112s. Now let's connect this to what I told you in the last video, the 1 kilogram problem. Do you remember? Samsung's new solid-state EV batteries require 1 kilogram of silver per vehicle, not 20 grams like the old batteries, 1 full kilogram. That's a 50 times increase in silver demand per car, and Samsung is not waiting for the spot market to deliver. They can't, because the spot market, the paper futures market, is a fraud. The number of paper contracts outstanding represents roughly 300 times more silver than physically exists in COMEX vaults. You can't redeem those contracts. You can't take delivery. The vaults are empty. So what did Samsung do? They prepaid $7 million to acquire an entire Mexican silver mine. Outright ownership, bypassing COMEX, bypassing futures contracts, bypassing the bullion banks entirely. Why would they do that unless they believe the paper price is unreliable? Unless they believed physical shortages are going to get worse, unless they expected that the COMEX price, the price you see on your screen, has no relationship to the price they'll actually pay to secure metal in the real world, and they're not alone. The Pentagon launched a $2.5 billion emergency stockpiling program, not for speculation, not for investment, for strategic national security. Because they've run the numbers and realized that modern warfare runs on silver, and they have zero reserves. Defense contractors are warning, we face a choice between arming ourselves, arming allies, or conserving silver-intensive components. Let that sink in. The U.S. military-industrial complex is rationing silver. They're choosing which weapon systems get built based on available silver supply. That's not a market in surplus. That's a market in crisis. And this morning, while you were watching the paper price crash to 103, Samsung and the Pentagon were on the phone with physical dealers, securing metal at $120, $125, $130 per ounce. How do I know this? Because the physical premiums didn't collapse. The premiums stayed high. In Shanghai, physical silver traded at $120 to $130 per ounce this morning. That's a 70 to 80% premium over the COMEX crash price. In Japan, dealers quoted $120 to $130. In Dubai, $125 to $130. In India, the equivalent of $108. While COMEX said silver was worth $103, physical dealers around the world refused to sell at that price, because they know the paper price is manipulated. They know the real price, the price where supply actually clears, where physical metal actually changes hands, is much higher. This is the widest gap ever recorded between paper and physical silver. Let me repeat that. The widest gap ever. The screen said $103, the physical market said $120. That's not a correction, that's a disconnect. That's proof that the paper market is a mirage. And guess who was buying at those premiums? Samsung, the Pentagon, Chinese manufacturers, solar panel companies, EV battery plants, industrial users who need the metal and can't wait for COMEX to maybe possibly deliver if the vaults aren't empty. You sold at $103, they bought at $120. You lost $17 per ounce by trusting the screen. They gained $17 per ounce by ignoring the screen and going directly to the physical market. Now let me show you the smoking gun, the one technical indicator that proves, beyond any doubt, that this was a trap, RSI divergence. The relative strength index measures momentum. It tells you whether buying or selling pressure is accelerating or decelerating. When price makes a lower low but RSI makes a higher low, it's called bullish divergence. It means that even though price is still falling, the momentum behind that fall is weakening. Sellers are exhausted. The spring is coiling. At $103, we had textbook bullish divergence. Price made a new low. RSI made a higher low. Combined with the volume spike and the rejection wick, this is the holy trinity of reversal signals. When all three happen simultaneously, it indicates a forced liquidation event, a stop-loss hunt, not organic selling. And the recovery? Immediate. The V-shape formed within hours. Everyone who knew how to read these signals bought the dip. Everyone who panicked sold to them. There's also the funding rate. In perpetual futures contracts, the leveraged instruments that retail traders use, there's a funding rate that determines who pays whom to hold a position. When funding is negative, shorts pay longs. When funding is positive, longs pay shorts. During the crash, funding rates flipped. They went from negative to positive, meaning shorts started covering aggressively and then flipped back again as longs re-entered above $105. This is not what happens during a genuine bearish breakdown. This is what happens when leverage gets flushed, whales accumulate, and the price recovers. So let me put it all together for you. JP Morgan paid $920 million and sent 2 traders to federal prison for spoofing precious metals markets. The exact same tactics, fake sell orders, cascade liquidations designed to trigger stop losses, were used on January 27, 2026. Same playbook, same crime, different year. While COMEX crashed to 103, physical silver in Shanghai traded at $120 to $130. Dealers refused to sell at the screen price. The crash was paper manipulation, not real supply. 60% of COMEX registered silver was claimed for physical delivery in the first 4 days of December 2025. 4 days. The vaults are draining, industrial buyers are bypassing COMEX entirely. Samsung bought a mine. The Pentagon printed $2.5 billion to chase supply that doesn't exist on exchanges. The CME raised margins 47% in 2 weeks during the lowest liquidity period of the year, Christmas week. Same playbook as 1980 when they bankrupted the Hunt brothers. Same playbook as 2011 when they crashed silver from $50 to $26. Banks change the rules when they're losing, and the V-shaped recovery to $112.50 combined with that volume spike at 103, combined with RSI divergence, equals institutional accumulation. Whales bought the dip, retail got shaken out, classic stop-loss hunt. Now I need to ask you something, and I need you to be honest. I need you to answer in the comments. Did you sell, or did you buy more? If you held through the crash, if you saw $103 and didn't blink, if you trusted the thesis, if you understood that paper manipulation doesn't change physical fundamentals, comment diamond hands. Let me see who's really in this for the long game. And if you bought the dip, if you saw that crash and added to your position, comment bought the dip. Because you just did what Samsung did. You just did what the Pentagon did. You bought physical silver at a discount while the paper market had a seizure. But if you sold, if you panic sold, if you got scared, if you let the chart shake you out, don't lie, don't hide. Comment, lesson learned. Because here's the thing, this will happen again. They will try this again. Every time silver approaches a new high, every time momentum builds, every time retail starts to believe, they will crash it during low liquidity hours and shake out the weak hands. And if you sold at $103, you need to learn from this. You need to understand that these crashes are not real. They are engineered. They are designed to transfer your wealth to entities that understand the game better than you do. The next time it happens, and it will, you need to be ready. You need to know that the dip is the opportunity, the crash is the gift, the panic is the trap. Because here's what they don't want you to understand. Here's the secret that banks and institutions and sovereign wealth funds know, but retail traders don't. Physical silver is in structural deficit. It has been for 5 to 8 consecutive years. The supply is shrinking. Industrial demand is exploding. Solar panels now consume 29% of all industrial silver demand, up from 11% in 2014. Electric vehicles have increased silver demand by 51% since 2016. AI infrastructure, data centers, 5G networks, all of it runs on silver. COMEX registered silver inventories have been drawn down 70% since 2020, from 346 million ounces to 82 million ounces. London LBMA vaults are down 40%. Shanghai inventories are at decade lows. The vaults are empty, the supply is gone, and the paper market is still pretending there's enough to go around. That's why Samsung bought a mine. That's why the Pentagon launched a $2.5 billion stockpile program. That's why physical premiums stayed at $120 while the paper price crashed to $103. The paper market is a lie. The physical market is the truth. And every single time they crash the paper price, they're giving you, the informed investor, the person who understands this dynamic, a discount to accumulate real metal at fake prices. So what's the floor now? Where do we go from here? The V-shape told us everything. $112 is the new floor. They tried to break it. They failed. The recovery was too fast, too violent, too definitive. The whales defended that level. The institutions stepped in. The physical buyers absorbed everything the paper market could throw at them. And now we consolidate, we build the base, we wait for the next leg up, because silver is not going back to $30, it's not going back to $50, it's not even going back to $80. The industrial demand is too strong, the deficit is too severe, The vaults are too empty. We are in the early innings of a supply crisis that will rewrite the economics of every industry that depends on silver. And the people who understand this, the people who didn't sell at 103, the people who bought the dip, the people who held through the manipulation, are going to be positioned for generational wealth transfer. But you have to hold. You have to ignore the noise. You have to understand that every crash is a gift, every margin hike is desperation, every low liquidity attack is proof that they're losing control. This wasn't a market correction. This was theft disguised as volatility. The banks that went to prison for spoofing in 2008 through 2016 are using the exact same playbook in 2026. But now they've weaponized CME margin hikes to make it legal. They crashed the paper price to $103 during Asian hours. They liquidated 67 million ounces from retail traders. And Samsung and the Pentagon bought the physical metal at $120. The paper market is a fraud. The physical market is the truth. And the banks just gave industrial giants a 15% discount to cover their supply crisis while retail got crushed. Don't be retail. Be the whale, think like Samsung, act like the Pentagon, hold your silver, buy the dips, ignore the manipulation, and remember, they only attack what they fear. And right now, they fear you. Comment diamond hands if you held, comment bought the dip if you accumulated, and share this video with everyone you know who needs to understand what just happened. The resistance is global, the truth is spreading, and they can't stop it.